Welcome to the 8th and final video of our Supply Chain Analytics series. Companies exchange goods and services to create value for their customers and generate revenues. In doing so, companies maintain working capital so they can cover costs until they get paid by customers. The working capital requirement depends on both financial and operational parameters. As the difference between days of inventory plus days of receivable and days of payables increases, so does the working capital requirement. There are 4 popular supply chain finance alternatives that finance the trade between a supplier and a buyer and hence reduce the working capital needs of companies. The first alternative is the early payment scheme, whereby the buyer pays before the final due date in order to get a discount for early payment. When a big buyer sources from a small supplier, the cost of capital is typically higher for the supplier than for the buyer. In this case, both parties can benefit if the supplier offers a discounted rate for early payment that exceeds the return on investment rates of the buyer. The second alternative, reverse factoring, requires that a bank get involved in the supply chain relationship to finance the trade. When a buyer has high credibility, they can help the supplier by asking a bank to finance the trade at a lower interest rate. This way, the supplier can get paid early by the bank with a very low interest rate. Then, the buyer pays the bank on the invoice payment date. However, buyers often ask to extend the payment terms when they accept a supplier into the reverse factoring program. The third alternative is the letter of credit. When a buyer does not know a supplier, the parties may involve their respective banks in the transaction. This way, the supply chain parties not only finance the trade, but also establish trust so that each one can feel confident that the other will fulfill their contractual obligations. The buyer asks their bank to issue a letter of credit and forward it to the supplier's bank. Once it is approved, the supplier ships the items ordered. After the documents are approved by both banks, the supplier gets paid by their own bank. The supplier's bank is later paid by the buyer's bank. The buyer's bank would either use the buyer's deposits or the line of credit for the payment. Given that the 2 banks are involved in the process, the fees are higher for the letter of credit arrangement. Hence, this route is not recommended for long-term supplier-buyer relationships. The final alternative is dynamic discounting, which involves offering an early payment discount on a sliding scale rather than a fixed-term discount value. Dynamic discounting makes it possible for the buyer to get benefit for varying payment dates and addresses some of the inefficiencies of a basic early discount scheme. Another difference between the early payment scheme and dynamic discounting is that the early payment scheme is offered by the supplier to the buyer, whereas the dynamic discounting sliding bar is offered by the buyer to the supplier. Cash-rich buyers offer the sliding bar to their suppliers so they can finance their suppliers with an early payment and earn a discount from this. However, cash-constrained buyers are often limited in financing their suppliers. To better allocate their limited capital, they first ask their suppliers to bid discount rates for their invoices to get early payment. This type of dynamic discounting implementation is referred to as the market mechanism of dynamic discounting. The allocation of the limited capital to invoices with different discount rates, payment dates, and invoiced amount can be modeled as a modified knapsack problem. In practice, big buyers could implement both the reverse factoring and dynamic discounting jointly to maximize the benefits from supply chain finance solutions. Reverse factoring helps them extend the payment terms with some suppliers, which improves the capital resources. The excess capital can later be used for other suppliers with dynamic discounting and thus benefit from early payments. Thank you for watching the last episode of this video series. Please visit our website for updates and for more information on our Supply Chain Analytics book.